What if I told you that while everyone's chasing yesterday's headlines, some of the market's most promising growth stories are hiding in plain sight, trading at discounts that could vanish overnight? I'm talking about companies poised for explosive upside, backed by strong fundamentals, but inexplicably undervalued by the broader market. I'll be breaking down each one, detailing their business, their catalysts, and the risks. By the end of this video, you'll have a clear picture of why these four stocks could be the undervalued gems you've been searching for. First up, we have Haemonetics Corporation, ticker HAE. This medical technology powerhouse provides essential hospital technologies globally, and their recent Q2 FY 2026 results were nothing short of a blowout. Adjusted EPS crushed forecasts at $1.27 versus an $1.11 estimate, and revenue hit $327 million, easily surpassing the $311.46 million expectation. This didn't just meet expectations, it ignited a pre-market surge of over 10%. Now, while reported revenue saw a slight 5% decline, the underlying adjusted EPS grew by a remarkable 13%, with an adjusted gross margin expanding 380 basis points to a robust 60.5%. This is a company showing serious operational leverage. Management's confidence is soaring, reflected in their raised full-year guidance, projecting EPS of $4.80 to $5, plasma revenue, organic growth of 14 to 17%, and free cash flow between $170 million and $210 million. CEO Chris Simon is bullish on the plasma segment, and Haemonetics is laser-focused on three core products: Nexus, TEG, and vascular closure. Raymond James and BTIG hiked their price targets to $90 and $88 respectively, while Bank of America upgraded the stock. The consensus from 11 analysts is a strong buy, with an average target of $84.55, and the high target reaches an astonishing $108, implying significant runway. The company has also been aggressively buying back shares, signaling belief in its own undervaluation. Despite a 60.3% surge in the past month, it's still 8.1% below its year-ago level, making its current entry point appealing. However, risks include competitive pressures in vascular closure, potential Vivasure acquisition integration issues, and regulatory hurdles. But with a low PE relative to near-term earnings growth and consistent profitability, HAE presents a compelling growth at a discount opportunity. Next on our list of undervalued growth plays is Oshkosh Corporation, ticker OSK. This global leader in purpose-built vehicles and equipment, spanning access, defense, and vocational segments, just caught the discerning eye of Barclays, who initiated coverage with an overweight rating and a bold $150 price target. That's nearly a 20% upside from its current levels. Despite a recent 10.8% slide over the last 3 months, analysts see a classic value setup brewing, a low valuation combined with an improving risk-reward profile as division recoveries gain momentum. Barclays highlighted several key catalysts. Firstly, OSK trades at roughly 10 times Barclays' 2026 earnings estimate, a significant discount even by peak cycle standards. Secondly, the critical access division's replacement cycle is expected to kick into high gear from late 2026 through 2028, driving substantial momentum. Thirdly, the vocational segment, encompassing fire trucks and aerotech, is experiencing strong orders and a growing backlog, while the transport division benefits from the stable, long-term USPS contract. Barclays pegs the downside risk at around 20% versus a 40% upside, painting a fairly positive outlook. While Q3 earnings beat EPS forecasts, revenue slightly missed expectations. However, Barclays believes the market is underestimating 2026 to 2028 sales as the access and vocational recoveries materialize. Adding to its appeal, OSK boasts a remarkable 13-year dividend growth streak and strong liquidity, with liquid assets exceeding short-term obligations. While FY 2025 revenue and EPS growth forecasts are muted, and 11 analysts have trimmed near-term earnings estimates, the consensus still points to OSK being undervalued, with fair value upside estimated at over 30%. This is a profitable company with a large price uptick over the last 6 months, signaling a turnaround that could deliver significant shareholder value. Moving on to our third undervalued pick, Booz Allen Hamilton Holding, ticker BAH. This technology giant, specializing in AI, cyber, and cloud solutions for government and commercial clients, has seen its stock plunge a staggering 43% in the past year, recently hitting a new 52-week low of $82.21. This severe correction, driven by disappointing Q2 '26 earnings, analyst downgrades, and broader sector headwinds, has created what many believe is a compelling buying opportunity. Despite securing a major $99 million Navy contract win, the stock remains under heavy pressure, which could be exactly where patient investors find their advantage. Q2 2026 results missed forecasts, with EPS at $1.49 versus $1.53 expected, and revenue hitting $2.9 billion against a $2.99 billion forecast. This triggered a sharp 9.4% pre-market sell-off. Revenue declined 8% year-over-year, and net income saw a 55% decrease, primarily due to challenges in its civil business. However, the national security portfolio showed remarkable resilience. Management is proactively tackling these issues with cost reduction initiatives targeting $150 million in annual savings. And while FY 2026 revenue guidance was revised slightly, CEO described a most bifurcated environment, with civil struggles contrasted by robust national security growth. The CFO notes solid demand signals across the board. Booz Allen maintains strong fundamentals, boasting a good financial health score and an impressive streak of 9 consecutive years of dividend increases, extending to 14 years of maintaining dividend payments. Independently assessed fair value points to $107.29, implying a 29.4% upside with high confidence and low uncertainty. While near-term revenue and EPS forecasts are negative, and it trades at a high PE relative to these short-term prospects, the significant discount to fair value and aggressive share buybacks by management suggest a deep undervaluation for this profitable company. This could be a prime candidate for a powerful rebound. Our fourth and final undervalued growth stock, poised for massive upside, is GoDaddy Inc., ticker GDDY. This company, widely known for domain registration and web hosting, is undergoing a dramatic AI-powered transformation, shifting from a traditional registrar to an AI-powered platform for entrepreneurs. Their strategic investments in artificial intelligence are not just buzzwords. They are fundamentally reshaping the company's future, making it a compelling, yet currently undervalued growth play. GoDaddy's Q3 2025 financial results underscore this momentum. Revenue hit $1.27 billion, beating analyst expectations of $1.23 billion, demonstrating 10% year-over-year growth. EPS reached $1.51, outperforming forecasts. Crucially, its applications and commerce segment surged 14% to $481 million, while the core platform grew 8% to $784 million. Free cash flow saw impressive 21% growth to $440 million, highlighting the company's robust cash generation. Management, buoyed by these results, raised full-year 2025 revenue guidance to 8% growth. The AI pivot is accelerating with the launch of Aero.ai, a beta agentic AI platform designed to automate business tasks through conversational interactions. GoDaddy is aggressively expanding from 6 to 22 AI agents by mid-December 2025 and is developing ANS as infrastructure for the emerging agentic open internet. Internally, AI's impact is staggering. 46% of its code was AI written by October 2025. And 90% of new platform code in the past year was AI-generated. Despite this innovation and strong performance, the stock has experienced significant volatility, reaching a 52-week low of $124.36, well below its $216 high. While some analysts have revised earnings expectations downward, the company maintains a good financial health score, and analysts suggest a potential upside of 33%. GoDaddy's focus on high-intent customers, with its 500-plus cohort now representing 10% of its base with near-perfect retention, is driving ARPU up 10%. This profitable company with a high shareholder yield and aggressive share buybacks offers a strong free cash flow yield and low price volatility, making it an incredibly attractive yet undervalued growth prospect in the burgeoning AI space. Now let's take a quick look at the numbers. Starting with market capitalization, we see a wide range. Haemonetics, at $3.75 billion, is the smallest of the group, suggesting perhaps more agility and potential for rapid growth if its current momentum continues. Oshkosh follows at $8.03 billion, while Booz Allen Hamilton stands at $10.07 billion. GoDaddy is the largest here with a $17.24 billion market cap, indicating a more established but still rapidly evolving player. When we look at revenue, Booz Allen Hamilton is the giant, pulling in $11.7 billion, followed closely by Oshkosh at $10.3 billion. GoDaddy brings in a respectable $4.8 billion, and Haemonetics, while smaller, still generates a solid $1.3 billion, demonstrating its strong niche in the medical tech sector. Gross margin is where profitability gets really interesting. GoDaddy leads the pack with an impressive 63.6%, reflecting its high-margin software and platform services, especially as it leans into AI. Haemonetics isn't far behind with 59.5%, underscoring its robust operational efficiency in specialized medical technologies. Booz Allen Hamilton comes in with 22.4%, and Oshkosh with 17.8%. These figures, while lower, are typical for companies with significant manufacturing or service delivery components. As for earnings per share, Oshkosh boasts the highest at $10.30, indicating strong bottom-line profitability. Booz Allen Hamilton follows with $6.57, and GoDaddy with $5.94. Haemonetics, at $3.45, is also clearly profitable. Finally, let's talk about dividends. Oshkosh provides a 1.6% dividend yield, and Booz Allen Hamilton offers a solid 2.6%, both demonstrating a commitment to returning value to shareholders. Haemonetics and GoDaddy, while not currently paying dividends, are likely reinvesting their free cash flow back into their high-growth initiatives, which for growth-focused investors can be a more attractive proposition. So these are 4 undervalued growth stocks, each with unique catalysts and significant upside potential that Wall Street might still be underestimating. Which of these 4 undervalued growth stocks do you think has the most explosive potential for the coming years, and why? Drop your thoughts, insights, and predictions in the comments section below. And don't miss our video right here on 7 best semiconductor equipment stocks to buy, according to hedge funds.